Hello, everyone. Thanks so much for being here. My name is Mehreen. I'm delighted to be hosting this panel on inflation, past, present, and future, which sort of implies a lot of things. One, that maybe we've turned a corner on a certain period of inflation, and also that our present is going to be looking a little bit different from what might be coming down the track. And to interrogate whether that is true, I'm delighted to have a wonderful panel with me. I'm going to start all the way at the end with Martin Wolf, who is the chief economics commentator at the Financial Times, a job he's been doing for a very long time. But I noticed that the New York Review of Books this month, Martin said that you're probably the most influential economics commentator in the English-speaking world, so there's no better endorsement than that. Then sitting next to Martin, we have another Martin Schlegel, who is still, I think, the newly appointed chairman of the Swiss National Bank. He joined 4 months ago, a very interesting time. Next to Martin, we have Julio Velarde, who is the long-standing governor of the Central Bank of Peru, a job that he's been doing since 2006. And next to me, we have Rania Al-Mashat. Rania has been the Minister for Economic Development and International Cooperation in Egypt for about 7 years, and before that she also worked at the Egyptian Central Bank. So I guess in previous Davos sessions, inflation was the most critical topic of the day. I'm thinking of the years of 2022 when in countries averaging in Europe, inflation was hitting double digits. It almost hit double digits in the US. In the UK, we were at 11%. And today, at the beginning of 2025, we have inflation that's just above central bank targets of 2% in the US and most of Europe. It's likely to undershoot some targets, and as we'll be hearing from some of our panelists, it has undershot some targets. And in other countries, it is still raging very much in the double-digit territory. Martin, I want to go to you because in those couple of years, it seems that we've managed to bring down inflation in perhaps more benign ways that anyone thought was possible. Unemployment hasn't really sparked in advanced economies. We've had small financial tremors, but no systemic financial crises. So is 2025 a good year for central bankers to be patting themselves on the back and saying, well done?
Well, one would love to believe so, but I'd be very worried if central banks started doing that, because they should always be forward-looking. They shouldn't be thinking about how wonderful they have been. I think I want to clarify how I think about this episode, because it's been a really interesting episode. And I feel that the idea of thinking of this as an inflation shock is not very helpful. It's not ideal. To me, what's actually happened, and it is a very rare phenomenon, certainly in the post-war period, it's a price level shock. So what happened is that over a period of 3 years, roughly, when one might have expected, that's what the inflation targets of the three big, of the UK, and then of course the crucial ones, the US and the Eurozone, would have implied the price level should have gone up 6%, and it actually went up about a fifth. And then it stopped. So that went back to the sort of 2% figure. And my view is that's not a supply shock. The supply shocks had an element in this. Essentially, monetary and fiscal policy created an environment in which a price level shock could occur. And you can think of it as accommodating that price level shock, or to some extent, I think very clearly contributing to it. But what is interesting is at the end of this price level shock, instead of turning itself into a spiral, it sort of halted. And but it's still a pretty important point that back in 2020, people didn't expect this sort of thing to happen. So the first crucial point, if you accept this analysis, is they mustn't do it again. You have to hope it doesn't happen again. And it would probably be different next time. It might not be so closely related to supply shocks. It could be triggered by demand that then starts creating a spiral and doesn't end in such a benign way. And if it does happen again, then the crucial thing that, in my view, controlled the subsequent inflationary process, namely the very strong anchoring of inflation expectations, might disappear. And so what are the risks, and this is where I will conclude, of not that episode, that was very special, it was linked to the pandemic and the war and the supply chain shocks and the monetary and fiscal policies during and immediately after the pandemic. But what are the problems now? Well, I think we have the following situation. Real interest rates look structurally higher than they have been for a long time. That makes public finances more vulnerable, inevitably, and the finances of many private borrowers more vulnerable. We have very high levels of public debt. Public debt, say, in the developed world is now back to where it was in 1945. Many major economies have public debt of 100% of GDP or more, with not that strong growth rates, so higher real rates, very high debt. Some very important countries, the US is the most important, have huge fiscal deficit, running at 6% of GDP in this case, could soon be higher. We have an enormous amount of private debt, and if you get private debt getting into trouble, that often ends up on the public's sphere. So there is a risk, I think, of, to put it crudely, fiscal dominance. And that is something that the monetary authorities will have to deal with. And that means, to my mind, that inflation could easily return. And it wouldn't be very surprising if Mr. Trump and the Federal Reserve got themselves in quite a bit of conflict over just that.
Okay, so the risk of fiscal dominance is most acute in the US. And if it happens in the US,
there are others, but it's pretty obviously the most important.
Okay, I just want to pick up on the price level issue, because central bankers probably find it difficult to think about price level. But if we think about our politics and the sort of cost of living crisis, it's the price level that is the most painful part. So when you tell people that inflation is going back to just above 2%, they'll look at you completely befuddled, because ultimately they remember where prices were and where they are now, and they would like them to go down. So that is a vote sometimes for deflation. I mean, Martin, how can central bankers think about price levels because they have very little control over this? And is this the sort of the sharpest end of what inflation is doing to our societies and our politics is about the level issue? And anyone else, I know we have two central bankers here, if you could also comment on how you feel about price levels and not just the rate of change. Yeah, Martin? Yeah.
Which Martin?
Both Martins can come back. Martin, can come back.
Okay, so let me first describe the situation in Switzerland. So after the pandemic in Switzerland, we had, like everywhere in the world, we had these supply bottlenecks, these supply chain disruptions, and this was combined with a very high demand after the pandemic for goods, because people had these high savings also from the pandemic, and there were these higher energy prices. And of course, lower supply and higher demand means that prices are higher, and this means that inflation has also risen in Switzerland after the pandemic. But in Switzerland, it was mainly imported inflation, for example, energy prices. So our reaction was the following. So first, we just let the Swiss franc appreciate, and this, of course, dampened the imported inflation in Switzerland. And then secondly, we started to rise interest rates. And maybe you remember Switzerland was at the record low. I think it was the lowest interest rates in the world at minus 75 basis points, so really deeply in the negative. And then finally, to further dampen inflation through the exchange rate, we started to sell foreign exchange. So in total, in 2023, we sold 130 billion of Swiss franc, which is a little bit more in US dollar terms of our FX reserves, to make the Swiss franc appreciate and thereby also dampen inflation. So I can say that we do not tap our shoulders and we do not claim victory, of course, but this policy mix was really very effective in bringing inflation down. We had a peak of inflation in Switzerland of 3.5%. You might think this is not much, but still our target range is from 0 to 2%, so it was clearly above the target. But then, like in mid-23, we were again in the target range, and the target range is from 0 to 2%, so we were again below 2%. So what do I conclude from this episode? Or maybe just to tell the whole story. Then afterwards we saw that inflation was falling quite quickly. We had easing deflationary pressure, so we eased monetary policy. We lowered interest rates last year 4 times, from 1.75% to currently 0.5%. And this is just because we saw that inflationary pressure in Switzerland is lower. So, but my conclusion here is that I have 3 conclusions. The first is that the monetary framework really has worked. And the second is that we should act early and swiftly. Just like waiting and not doing policy measures does not increase the room for maneuver in the future. It decreases the room for maneuver. And the last one, I think, is almost the most important point here, is that as a central bank, we really have to explain what we do and what our goal is, what our objective is. And it's 3 things. It's price stability, it's price stability, and it's price stability. I think I said a lot of times in the last couple of years price stability, so that everyone understands that we are really, really committed to price stability, and also inflation expectations stay anchored. And so far this has worked.
I mean, is it true? Would it be true to say that past, present, future doesn't really apply to the Swiss National Bank, because you seem to have a brief interregnum, but basically things have gone back to where they were, and we're again maybe looking back into the barrel of negative interest rates. So how much has really changed in your job?
So at the moment we are at 0.6 with inflation, and also the inflation forecast is well inside the range over the whole forecast horizon. But of course, we look at the situation very closely, we monitor the situation very closely, and at the moment we cannot exclude negative interest rates. But I also have to say, in Switzerland, nobody likes negative interest rates. Also, the Swiss National Bank doesn't like negative interest rates. But as a central bank, we can never exclude any measure.
Ronnie, I want to come to you because it feels like a bit of a luxury to talk about the price level when actually in Egypt inflation is still raging around 27 or 28%. And that is lower than the crisis of 2022 when it nearly hit 40%, and Egypt suffered brutal capital outflows at the height of the war, Russia's war in Ukraine. Talk to us about where you are now and how you think about the inflationary challenges after a very, very tough couple of years.
Well, if we talk about inflation before 2020 in general, we were at certain levels or averages. And then after 2020 until now, globally, inflation is at higher levels across different regions. I just want to comment on your point on price level targeting. You know, being a student of monetary policy and practiced it, it's very, you know, we don't have many central banks that are targeting price level. And that is an issue that you know, we need more practice in that so that it can be more widespread. But I totally agree with you that the public, when you tell them we are on target, inflation is on target, sometimes it's very difficult for them to feel it just because of the price element. In our case, there are multiple issues. First, you're doing fiscal consolidation, and part of fiscal consolidation is adjusting subsidies. Subsidy adjustments does have an impact one time off on price level, but then they show up in inflation. For all emerging markets, right after the Ukraine-Russia war and the increase in commodity prices and energy prices and the increase in interest rates in the US, there has been capital flight, so that has affected inflation rates or imported inflation in that sense. What's happening now, we do have a very favorable base effect from last year, so inflation will come down automatically, probably by 10 basis points, just by the sheer impact of base effects. But again, fiscal discipline is important, transparency with respect to monetary policy. These are all very conventional things that we repeat in communication, but I feel that the risks going forward in general are going to be the impact of protectionism, what was announced a few days ago on tariffs. Will we see a capital flight probably from emerging economies back into the US, when we're trying to be in an environment where we are bringing in investment in order to solve some of the supply side shocks. Will we be able to, as emerging markets, bring in that investment in a situation where there's a lot of attraction in the US compared to emerging markets? So all of these are, I would say, upside risks on inflation, upside risks also on expectations. So there is a period coming up where emerging markets are going to be, again, put under a lot of pressure for cost for the inflation, but also the cost of financing, which again impacts fiscal, as Martin mentioned, and then that is going to also affect expectations.
We'll get on to the US, but Julia, I want to go to you because Peru has the lowest interest rates and inflation rate in Latin America. I think you just fell below 2% at the end of last year. So are we allowed to celebrate you as at least one of the central bankers that seems to be doing pretty well, even if we can't apply it across the board? How do you see the situation?
Yeah, we finished in 2%. We expect to be around 2% this year. Although the end of the first quarter, we might be very close to 1%.
Okay.
We expect to be close to 2% at the end of the year. Actually, I will talk about the Americas maybe because I follow it more closely. Canada and Peru, we had lower inflation. And the last mile that was very talked about was not so hard for us, and neither for Canada, by the way. The big countries are seeing their inflation decreasing, exception maybe Brazil, that it might pick up this year, and America, where probably inflation is going to stay around 2.5. Even those are the Fed projections where you talk with them, no? A little bit lower than now, but it's like around 2.5% this year. Of course, the risk is that inflation might be higher later. And one point that there were some studies last year how expansionary policies in the States affect commodity prices. And there was a point being made in 2009 by F. Frankel that explained the increase in commodities because of expansionary monetary policy in the States. So there might be some surprise. Of course, supply shocks were there, but also not only commodity, I believe, affected somewhat also the increase in commodity prices. Of course, because expansionary monetary policy around the world, it's a commodity inflation. No? Just 1 point, the prices, level prices. Sometimes finance minister and governor of the central banks have not shown enough empathy when commenting level prices. I remember Bernanke talking about inflation, saying, but the iPad has a lower price, and people shouting him, but I cannot eat my iPad. Or even a worse case in the Minister of Finance of Chile was a long time. The Demonstration 2019, inflation was going up. He said, flowers are coming down, are down 20%. He resigned at the end of the week because he was so criticized because of lack of empathy. And I believe that is the main point. We are concerned, and it was mentioned by Martin, about the effects of expansionary policy in the States that will affect inflation. In our case, we are not so concerned, except if it goes to commodity prices. Okay. In that case, we will be affected. One, poverty was really affected not only by COVID, by increase in commodity prices. Compared to Switzerland, for example, when the price of grains increases, it fits more into CPI than in case of Switzerland. Let us say a loaf of bread. The price of wheat is maybe 2% in the case of Switzerland, because the sale of bakers, the rate of the bakery. In Peru is much more important. Okay. So commodity prices affect us much more.
Okay, so I guess let's talk about Trump. It's been 10 minutes. Martin, is the spectre of inflation and this worry about price level that politicians have actually could be quite useful, maybe reining in some of the, I would say, most extreme ends of what Trump is proposing? Obviously tariffs on deporting migrants and fiscal expansion through tax cuts and other things. Is this consideration actually the element that will maybe make Trump 2.0's promises a little bit less than what we might have been expecting, because he, of course, is as cognizant as the deleterious impact of inflation as anyone else?
So it seems to me perfectly possible, though we are then discussing the internal political dynamics of the administration, which one would have to say are very, very uncertain at the moment. I think that the people making policy, and I suspect Trump himself, know from just looking at how they won, that a big price level shocks or cumulatively significant inflation, same thing, are not very politically popular, and so that would be one good reason to try and avoid it. And they also know, and certainly the new Treasury Secretary unquestionably would know that sort of thing, that if that happens, the Fed will respond. Or if they don't, because they're bullied, either way, there's a very good chance that Wall Street will get pretty nervous. Long rates will probably go up anyway, and that could spook financial markets, which are the one thing stock markets, which Trump clearly cares about a lot. So it would seem that a prudent policy will be to avoid a really serious excess demand situation. So that would be the sort of the optimistic view. The opposing view would be, well, he's committed himself to policies which are likely to have that outcome, because what he's inherited, despite what he said in his inaugural, is a very strong economy with full employment, an already enormous structural fiscal deficit, very high debt, and the pretty highly pressured labor market. So if he adds any more to that, particularly with possibly substantial tax cuts, this is still to be debated. If he significantly shrinks the labor force by trying to export millions and millions of undocumented aliens or drive them out of the labor force. If he raises tariffs very significantly, that's more complicated. It depends there what happens with the exchange rate. The normal offset is that the dollar falls, but that's not what he would like. So he might want to keep the dollar strong too. It's very incoherent. You could imagine, but he might end up with a strong dollar, and he quite likes it. But that's, again, a bit of a query about how that will play. You could easily imagine them ending up with a significant inflation rise. Already inflation has been very resilient. I mean, it hasn't come down as much as expected. And the Fed has already indicated, I think, and that the assumptions that we had a little while ago of 4 cuts really looks off the table. So put all these things together. On the one hand, this is something they don't want. On the other hand, it seems to be where they're going.
Yes.
So the question is, who will win?
Yeah.
What will win? With Trump, I never forecast what he's going to do.
But I think that we heard from the Treasury Secretary before the inauguration, he did a Congress hearing, that they are cognizant about the inflationary impacts of their policies, because Scott Bessent will say, well, the dollar then rises to offset some of that. So they're already trying to at least find a palatable way to say that what we're going to do is not...
But it undermines the tariffs.
Exactly.
And it's not clear that's what Trump wants. He wants the strong... He actually, if you follow this carefully, he clearly wants a strong dollar and a weak one. And that creates a problem.
He wants a global reserve, but do things to undermine that status. Does anyone else want to jump in on the US? I mean, Ronnie, I'm looking at you. As you already mentioned how exposed Egypt will be to whatever the monetary and fiscal situation in the US is. We also mentioned in the Green Room that Egypt has had a relative positive in the fact that the ceasefire in Israel and Gaza should help, I guess, the investment climate and generally the climate around Egypt. So how do you weigh those two things together?
Well, first, it's not what's happening in the U.S. is not Egypt specific. Sure. It's more emerging markets specific. I think it's the degree, so and how fast the increase in inflation and therefore the not reducing interest rates as much as expected earlier. So these are all things that will show up in the period ahead. We have some positives, of course, with the ceasefire. This is going to create, hopefully, more Red Sea or a return of the Red Sea navigation, and therefore more inflows into the country. So this should also reduce imported inflation in a large way. But I just want to talk more about the more general risks. We didn't talk about also climate has inflationary risks, particularly when a lot of the commodities globally that are produced are also imported in many of the countries. So that's one element which is considered to be a risk. And then finally, the divergence in productivity between different countries, that also affects very much the inflation differentials that we see. But again, I think being clear on monetary policy frameworks, trying to continue on the structural reforms as much as possible to reduce the impact of some of these shocks, open up more for investments that can reduce inflation. I think all of these, I mean, what to do is very much within the conventional sphere that monetary policy and central banks and fiscal policy has been doing. But the point is how fast and also in order not to renege on many of the development objectives that the country has.
Sure. Julio, Martin, do you want to come in on how you're affected by the US?
Yeah, besides the factor restricting a dollar that have been mentioned a lot, that is bigger fiscal deficit, probably the rate remaining higher, also I believe the uncertainty itself tends to restrict the dollar. The US, besides Switzerland, is seen as the safest haven around the world, no? So probably we'll have a strong dollar at first, and that will affect us, might affect us inflation.
Even stronger than now?
Yeah, at least for this year, I suppose, it's harder to, it's very hard to say what will happen. A factor that can affect that positive to lower inflation might be tariffs on China. China might be forced to export more to other countries, and there will be deflationary, no? Especially if the renminbi also depreciates. No? That would be the main points.
Martin?
Maybe just like a short word from the Switzerland's perspective. Of course, the US is a very important trade partner for Switzerland. Switzerland is a small open economy. It's really reliant on trade. We have a huge part of GDP is actually exported. So tariffs would certainly not be good for Switzerland, but would also globally not be good for trade. I mean, it's generally now a time with very, very high uncertainty. It's geopolitics and also, of course, this, the trade conflicts at the moment.
We're going to throw it open to questions. Martin, do you want to come back quickly?
Yeah, just one small point, which I think has been made, but it will really emphasize when the US gets into an inflationary situation in which forces the central bank to tighten, because it's the US, that tends to strengthen the dollar a lot. And indeed, it has, and I think that's already because markets realize interest rates in the US are not going to fall so much. That will tend to mean that exchange rates of other currencies around the world will weaken, and that's particularly significant for emerging economies and developing economies. And for them, this is inflation. And it's a price level shock for them. And they would, that creates a very big problem, because if they tighten monetary policy, that creates domestic problems. The higher dollar rates have a direct effect on them because so many of their borrowers, including the state, are leveraged in dollars. They don't borrow domestically. They are borrowing in large part in foreign currency. So this situation that we describe is both a real and a monetary shock to emerging and developing countries, many of which are very fragile. And we saw that, and think of the Volcker episode, which is an extreme version of this. So what we are describing, if this happens, is a general problem. The famous mark of Treasury Secretary Connolly, the dollar is our currency and your problem, becomes relevant again.
It's also Donald Trump's problem too, because it's also Donald Trump's problem, the dollar as well, so ours and
I think in the end, actually, it's always everybody's, including the Americans, but there's no question if this cycle emerges, and it's a big if, that this would have wide repercussions, including developing countries, but even more in developing and emerging countries.
Anyone with some questions? Yeah, we got one at the front. I will group them together. If anyone else? Okay.
Thank you very
much. Just let us know who you are.
Thank you very much. My name is Markus Diemeyer from Switzerland, Handelszeitung. I have a question just about what Martin Wolf said in the end, about the risk of a currency turbulence. I think, as I understand you, and as it's maybe probable, that there is a high risk when, with the Trump tariffs, and maybe even more when the weakening of other currencies is seen by Trump as a strategic answer to the tariffs. So how, I think you talked about the emerging markets, they have a problem because of inflation, but maybe also because of the turbulence and in the currencies itself, and then certainly also Switzerland. I mean, we had this situation that the US was suspecting other countries of an unfair influence on the currencies. So I want to know what you think about that and what you will do. Thank you.
Does anyone else beyond Martin want to take that? Yeah, Julio?
I will talk about Martin.
This Martin.
I remember the first period of Trump. He was attacking Switzerland, among other countries, those countries that had a surplus with the States and intervened in the market. He believes that when you depreciate or do not appreciate, you are playing unfairly with trade. So it is important what you are saying, I believe. No?
I mean, Martin?
I mean, just a very important point, because this fits into the Trump view of the world. So if he has high tariffs and a consequence of that is essentially you've got a devaluation through the tariff, and so that allows the dollar to appreciate. And that reduces the effect of the tariff on the price level. And he could like that, because it means it's less inflationary in the way it looked. But it also reduces significantly the effect of the tariff on reducing the effect of the tariff, which he wants, in reducing the trade deficit, which is not really only transitory anyway. So which matters more to him, inflation or the trade balance effect, over which time period? And I don't think he knows, because I don't think he has any sense of how these things fit together and how the administration will handle. But I think what was just said is right. He will think that if one of the consequences of the tariffs, which reduce imports, is to make the dollar stronger, and the rest are exchange rates of other currencies are weakening, that's cheating.
Yeah.
And it could create a big question. And I think that's a very important question. You might go after countries for that reason.
Well, I guess we have one quick question really quickly. We'll just see if we can get some...
Yeah. Isabella Weber from the University of Massachusetts. I had a question for Mr. Schlegel on the Swiss case. So we have seen that Switzerland had extremely low inflation, and Switzerland also has a whole range of pretty unconventional institutions like the Preisüberwacher, public buffer stocks for a number of critical things, high public ownership in the energy sector, and so on. So I'm wondering, like, how do you see the impact of these rather unconventional institutional arrangements on inflation in Switzerland? The second part of my question would have been, what is the scope for unconventional measures under the Trump administration, where he might pull off very unorthodox things in addressing inflation? But maybe that's too much for today.
Okay, so should we be a bit more like the S&B? Martin?
Yes, thank you for the question. So the Swiss consumer basket is indeed a little bit different than the one abroad. So for example, the share of energy is much lower. So people spend less on energy, electricity, and so on. And electricity is also an administered price, so it only changes once a year. Also, what's quite high in Switzerland is also administered price, which is health care. This is roughly like 15 to 17% of the consumer basket. So there are some effects that really were in favor of lower inflation because they move less. But the main part of inflation that we had was really was imported, and there the currency, the appreciation of the Swiss franc was really helpful.
Rania, you sort of gave a tacit endorsement for central bankers to be a bit more unorthodox because price levels are so poisonous to the way people think about the economy. Is it time to get a bit more heterodox?
No, I mean, what I'm trying to say is that on the price level, that's what people would understand most, but it hasn't been tested yet across many central banks. I don't know if there's any central bank that actually targets price level. We read it in theory. You've seen so many papers that advocated. There's also interest rate targeting, so that you can also give people a better view of where interest rates are going. But these have not been tested in a big way, and the amount of headwind shocks that are taking place simultaneously are I would say putting a lot of pressure on emerging markets, particularly when we're trying to put our house in order. So you're trying to put your house in order, hoping that around you is tranquil, but you're doing that in a very bumpy and volatile and unorthodox policies from different places and places that matter. So this is, again, we'll see.
Fantastic. We have run out of time. I think this was a very good primer to make people...
Just make one tiny point, because
very fast.
I think wage price controls are imaginable.
Yeah.
And desirable?
No, insane. But I've lived through that with the Nixon shock. I was in Washington at the time. Very bad idea. But I could imagine him deciding to do that.
Okay. We're all very primed for Donald Trump to be addressing the Congress about 5 o'clock. So you know what? If he's going to make some news, we've been prepared well. Thank you, everyone, and thank you to the panel.